Okay, picture this. You've got a solid deal. The price is fair, the buyer seems totally on board, everything's lining up, and then you get that call. Out of nowhere, they need a price drop. Ugh, why does this always happen? Well, today, we're pulling back the curtain. We're going to get into the bank's secret playbook and finally understand why your buyers suddenly can't afford the price you both agreed on.
And this quote right here, it flips the whole script. See, you think you're shaking hands with the decision maker, but you're not. There's this invisible person at the table, the lender, and they're the ones really calling the shots. When they say no, your buyer has no choice but to come back to you, hat in hand, and suddenly your perfectly good price is the problem.
So, let's get into our first section here, the invisible negotiator. And this is a huge mindset shift. You think you're selling a property, with all the hard work and value you've poured into it. But to the bank, you're not selling to a person, you're selling to a spreadsheet. And that's the thing about the spreadsheet. It has zero emotion. It doesn't care about the new roofs, the great location, the awesome tenants you found. It is completely, totally, brutally impersonal. All that value you've built, it just boils it all down to one single critical number.
And this right here sums it all up. The rule that governs that number, it's not a negotiation. It's a pass-fail test. It's a gatekeeper that just says yes or no. So let's meet the main character, or let's be honest, maybe the villain of our story, this little acronym called the DSCR.
All right, that brings us to our second section, the bank's magic number. Now I know, it sounds like some complex financial jargon, but don't worry. We're about to unlock the code behind this three-letter acronym that holds so much power over your deal. Okay, so what is this thing really? DSCR just stands for Debt Service Coverage Ratio, and all it is the bank's personal safety check. It's how they manage their risk. It answers one really simple question. Does this property make enough money to cover the mortgage payments plus a little extra, just in case? And that little extra, that's the bank's cushion, and it's totally non-negotiable. And here it is, the magic number, 1.25. This is the gold standard. When a bank sees a 1.25 DSCR, they can relax. It means for every single dollar the buyer has to pay on their mortgage, your property is generating $1.25 in income. That extra 25 cents, that's the bank's peace of mind. So, how does this actually play out? Let's walk through it. Let's say your property's net operating income, your NOI, is a nice round $100,000 a year. The bank comes in and applies its 1.25 safety cushion. They just divide your income by their ratio, and they land on $80,000. And here's the thing you have to understand. That is the absolute maximum annual mortgage payment they will ever approve. Your property's income puts a hard ceiling on the size of the loan. And this is where it all clicks into place. Every time your buyer comes back talking about a shift in the market or changing interest rates, what they're almost always describing is a DSCR problem. If interest rates go up, that $80,000 mortgage payment suddenly supports a much smaller loan than it did a month ago. And just like that, there's a huge gap between your price and what they can actually borrow. Okay, let's dive a little deeper, because it's not just about the DSCR. In Section 3, we're going to see how other loan terms can come in and attack your deal. Let's talk about how something called amortization can quietly, sneakily shrink your payday.
So amortization is just the timeline for paying off the loan. Simple, right? But as you can see here, the length of that timeline changes everything. If the bank gives the buyer a shorter term, say 20 years, it forces them to have much higher monthly payments. Well, those higher payments make it way harder to hit that 1.25 DSCR target, so the bank approves a smaller loan, which gives the buyer the perfect excuse to demand a price cut from you.
So from now on, when you hear that phrase, you'll know exactly what's happening. It's not some vague, mysterious issue. It's just the bank's math playing out. The bank changed the terms is just code for, hey, the loan got smaller, and now I need you to drop the price so I can close this deal. And this brings us right to the heart of the conflict in pretty much every deal, the seller versus the bank's reality. It's this constant battle between what you know your property is worth based on its merits versus the cold, hard calculation of what a bank is willing to finance today. And this table just lays that gap bare. Look at this first row. You, the seller, are thinking, my property makes $100,000 in income, so at a normal valuation, it's worth $1.25 million. Makes sense. But the bank looks at today's interest rates and says, nope, that same income only supports a $900,000 loan. The outcome? The buyer now has a $350,000 hole in their financing, and they're looking at you to fill it. This is it. This is why deals get renegotiated or just die right at the finish line. This is honestly the perfect way to think about it. The bank isn't out to get you. They're just the referees, enforcing the rules of the game. They don't play for either team, but their calls from the sidelines are what ultimately decide who gets to score.
Okay, enough doom and gloom. Let's talk about solutions. That brings us to Section 4, your winning playbook. This is how you stop reacting to the bank spreadsheet and start anticipating its moves. This is how you take back control and protect your price. The key is to get way ahead of these financing problems. Before you even think about signing a contract, you ask your buyer these 3 simple questions. Number 1, who's your lender? Number 2, what's their DSCR requirement? And number 3, what amortization and loan term are you actually working with? You're basically running a quick audit to see if they can actually close.
And here's the immediate payoff. If the buyer can't answer those questions, if they hesitate or stutter, that is a gigantic red flag. It means they're not nearly as prepared as they want you to think. And by spotting that on day 1, you've just saved yourself 2 months of headaches on a deal that was probably doomed from the start.
But what if the buyer is solid, but the bank's math just isn't working? Well, you have a secret weapon, seller financing. By offering to become the bank yourself, even for just a piece of the deal, you get to bypass all those rigid bank rules. You can create terms that actually work, keeping the deal alive at your full price. Plus, you get a steady stream of interest income, and the buyer gets the deal done. It's a total win-win.
And you've got to start thinking about it this way. A bank saying no isn't a dead end. It's an invitation to get creative. For the seller who understands this stuff, a lending gap isn't a problem. It's a profit opportunity. So, as we wrap this up, the whole strategy really boils down to this one truth. The bank's lending limits are going to affect your deal one way or another. The secret to winning is to know what those limits are and to bring them up on your terms before the buyer has a chance to use them as a weapon against you. So here's the final thought I want to leave you with. Your deal is not a straight line between you and the buyer. It's a triangle. You've got the buyer, the seller, and the bank. And the only way you can truly win, the only way to control the outcome, is to learn how to think like all 3.